that. I'm gonna have to reset everything somehow. I don't even know how to get rid of it,
No worries, no
to
worries.
be honest.
Cool. So I'm in, James, you're in. Ange, Sai, and Jesus. So Ange and Sai are my assistants. Hey, there's James. So
There I am.
Ange and Sai are my assistants. They're our cold callers, our virtual assistants. America, another virtual assistant. That's my wife's cousin down in Guanajuato, Mexico. Jesus Salida is another realtor. And I think that's good. So I'll start. Medica mute. There we go. Okay, perfect. We muted that. I don't need to share my screen today. Am I recording? Yes, I'm recording. All right, we're good to go, James. If you appreciate it, maybe go over briefly over 1031 exchange, how they work. We have a couple of more than a couple of sellers that are interested in more information, and I know there might be some tax changes coming up with the Biden administration. But anything you can help us out with, we're ready to go.
Sure. So just get into it right now.
Yeah, just get into it. Go for it.
Okay, so the 1031 exchange is the code in real estate that allows you to sell and buy investment property. And if you follow certain rules and guidelines, you'll be in a position to pay zero in capital gains tax. This is huge because we're in California, actually anywhere in the United States right now. There's massive appreciation and huge capital gain consequences. But in particular, in the state of California, you're paying probably between 30 to 35% on every dollar of gain if it's not reinvested into other pieces of investment property. And I don't know if you guys are aware, but over 35% of the property in the Bay Area in general, in Northern California, for the most part, residential property is investment property that qualifies for a 1031 exchange. So if you're not going after it, your competitors are, and you're truly missing out on that opportunity. Now, I think it's really easy to determine what is and what isn't a 1031 exchange opportunity. To be real simple about it, there are three types of property that do not qualify. So, number one, the primary residence does not qualify for a 1031 exchange. I think we all know that if we've lived in the property 2 out of the last 5 years, you qualify for the 250 or $500,000 exclusion on that primary residence gain. So if you're single and 250,000 of your gain on that property when you sell it, it's not subject to capital gains tax. It's tax free. Everything up and above is subject to capital gains tax. If you're married, that limit is $500,000. So as long as you lived in it 2 out of the last 5 years, that's a great exclusion that your clients can take advantage of. So that the 1031 exchange does not apply to an owner occupied property in most cases. So Bay Area, as well as other places, are a little bit different because we have so many properties out there that have casitas, in-laws, or mixed use type of property. If we go into San Francisco, just for example, if you look at the Sunset District of San Francisco, I'd say about 90% of the properties out there have in-laws, and I'd say over half of them are rented. So when they sell that property, they're qualifying for the 250, 500 on the portion that they are living in, but the portion that they're renting qualifies for a 1031 exchange. So a primary residence by itself doesn't qualify for the 1031 exchange. But when you got a mixed use component out there that do 1031 exchanges also live on the farm, so they get the 250, 500 on the portion they live in. And then let's just say, for example, the almond farm or the asparagus farm or whatever it is, that portion would qualify for the 1031 exchange. We have a lot of that out here, and it's not just farms. Look at the vineyard, same thing. They live on the vineyard, they run the vineyard. You can do a 1031 exchange and get the primary residence exclusion. Again, let's go back to Oakland and San Francisco. How many duplexes are there out there where they live in one unit, rent the other unit out? You got the opportunity to take advantage of both section codes in the sale of that asset. I did a transaction for this dude in Berkeley who sold a 16-unit building, and he lived in one of the units, and he's like, can I take the 250, 500 on this one unit and exchange the rest? I'm like, all day long.
So how
All
do
you
they
got
do
to
that? Sorry to interrupt. So do they just average it out over the 16 units and
It should be on the tax returns. So you depreciate depreciate the asset, and they'd probably depreciate a certain percentage of that asset. You don't want to make it up ever as the realtor when it comes to something like that, but you want to be aware that, okay, there's a percentage here. That percentage has to come either from their tax advisor, or if they don't really do it properly, then somebody's got to come up with the number, whether it's via appraisal or what have you. The units are exactly the same. You could probably say it's a 50-50 split, but some duplexes, one's a 3 and 2, the other's a 2 and 1. The numbers aren't going to be the same. So somebody's going to have to come up with those numbers, but on a mixed use property, you could take advantage of both section code 121. That's the primary residence exclusion, and section code 1031. So the primary doesn't qualify, but now we know that. Let's make sure it's only a primary, because throughout COVID, how many people are working from their homes right now and they got a home office and they claim that on their tax returns? Another example of a mixed use property. So there's so many different things out
I didn't even
there.
think about it that way. Claiming your
Yeah.
personal residence as your workplace.
Got to do it on your tax returns to make that work. And a lot of people do that, and they have their own workspace at their house, or they rent out rooms or what have you. If there's an investment component to the property, that portion is not protected by the 250, 500. That portion's only 1030. The strategy on how that really works well in a 1031 exchange, but for all purposes, it does not qualify for a 1031 exchange. We just got to make sure it's only a primary to at least get whether or not that portion or there is an investment portion to it or not. Second piece of real property that doesn't qualify for a 1031 exchange is the second home. Second homes don't qualify for anything. So when you sell a second home, you're paying taxes. It's not invested. I live in this. Oh, no, you can't. Look at your tax returns. Which one do you put there? That's your primary. Done. Don't argue with me about I spent more time this year here in my second home more than the other one because of COVID. I was in Tahoe longer or wherever. It's always on your tax returns. That is going to tell the story. So the third piece of real property that doesn't qualify for the 1031 exchange is the flipper. If I buy it, I fix it, and I sell it, don't qualify. You got to rent it. It's got to be treated and operated as investment property in order to work. So let's look at that. Primary doesn't qualify. Second homes don't qualify. By the way, second homes, by definition, if I use the property more than 14 days out of the year for personal use, it's now considered a second home. If I want to keep an investment property, rent it out a minimum of 14 days per year, don't use it more than 14 days per year, do that for 2 years. Then when I sell the asset, I can do a 1031 exchange. You only have to Airbnb it a little bit of time for that to be used and treated as investment property.
Only
so making the
days,
switch,
sorry?
only 14 days. I mean, if you want to just let it sit and not collect income and rent it out, 14 days, a couple of short-term rentals, that'll work for you. But that's the minimum criteria, but you can't use it more than 14 days for personal use. You can't have your kids go there and not have them pay rent from, that'll count as one of the 14 days. So working on the property doesn't count as one of the days, but just be conscious of the time frames. Now, the flipper doesn't qualify because property held for resale purposes doesn't qualify. So what they say is buy it, fix it, rent it. How long do you rent it? It's up to the CPA. There's no black and white on this. They're either going to say 1 or 2 years. The aggressive CPA says 1 year. The conservative CPA says 2 years. And the guy in the middle says just cross 2 years on your taxes. So
that makes sense.
It'd be like a year and a half, and you're going to show up on 2 returns, and you're good. So buy it, fix it, rent it for 1 to 2 years, depending on how long the tax advisor recommends, then do the 1031 exchange. Other than that, everything else out there qualifies for a 1031 exchange. There are a lot of properties out there, and so many people ask me, they're like, James, I don't get it. Why do people do 1031 exchanges? What's the real reason? It's got to be not paying the tax. I'm like, nobody does a 1031 exchange not to pay the tax. If you don't want to pay the tax, don't sell the property. You don't sell, you don't pay taxes. People do a 1031 exchange to get a better piece of investment property. People do a 1031 exchange for a number of different reasons, right? Some people hate tenants, trash, toilets, termites, taxes, and they're just done dealing with people. And they want to go into some other type of investment property where they don't have to deal with the tenant wanting to break, not paying rent, messing up the property, bringing pets when they aren't supposed to, all the bad things that you can have when you have that landlord position. Some people just say, you know what? I'm tired of California. I'm done. I want out. Gavin's just nickel and diming me for everything. This soft story crap they got in the city, this rent control they got throughout California. I'm done. I want out. I want to do a 1031 exchange to get out of California. Some people say, you know what? I bought this property in 1975 for nothing. Now it's worth $2-3 million, and the rent I'm getting makes no sense. I need better cash flow. And this property was built in 1908, and I'm sick of the maintenance. So I want to get out of this property to get better cash flow. And you know what? I'm tired of residential property. I want to go to commercial property. You can do that in a 1031 exchange. I want something completely passive. I want to go into something where I don't have to manage it whatsoever and I get a better rate of return, a new depreciation schedule, and I do not want it in California. You can make that happen in a 1031 exchange. So many people out there call me up and say, dude, I don't want to do a 1031 exchange. I'm done with investment property. Here's what I want to do. I want to get out of California. I want to get some money and I want to go buy property and I want to retire in Hawaii. Can you make that happen? I tell them, yeah, I can make that happen. Here's how it's going to roll. You're going to sell your investment property. You're going to do a 1031 exchange. You're going to buy that property in Hawaii for the first, all that 14-day rule. Then I want you to retire, sell your property, do a 1031 exchange, buy your dream home, rent it out initially, then sell your primary residence, get that exclusion money, and then go move into that property, saved all the equity, and you're done. The name of the game is find out what your potential client does not like about the property. And when we find that out, we'll let them know that there is an exit strategy that will provide the solution that they are looking for. You'll get the listing, you'll get the replacement property. And to me, that's 2 commissions and a happy client in a very short period of time. So when we're talking 1031 exchange, yeah, it's a great benefit not to pay the tax. But the true benefit is you're unloading an asset that no longer makes sense to you for whatever reason to get into a better situation. And you can make that magic happen in a 1031 exchange. So here's how it would work. Let's just say I bought a single family home years ago. Maybe it was my primary residence at the time, but then I got married and we left that house and we didn't sell it. We rented it. And now we've owned it for 20 years and we're just done with it for whatever the reason is, massive appreciation. We need to sell this property and we don't want to pay the taxes because we have $1 million gain. We know we'd lose about $300,000 to $400,000 in taxes. And so here's what we want to do. We're going to sell this property. We're going to do a 1031 exchange and get into something different. So we list the property for sale. We have an exit strategy in place. We want something completely passive. Of course, we're tired of dealing with tenants. We list it for sale. And then what? In like 2 days or 2 hours or 2 minutes, we've got like 70 offers and we're in contract and we open up escrow. So it's like a regular transaction, right? We list it for sale, go on the market, get offers, accept an offer, open up escrow. That's when we open up the 1031 exchange account. You need a qualified intermediary. That's what I am. The qualified intermediary puts together the legal documents that will assign us into the rights of the contract and have us act as the seller. The reason why we have to be the seller at the close is because if the actual seller touches money, they're taxed. You can't touch money. So the qualified intermediary, the exchange company, the accommodator, whatever you want to call us, puts together our legal documents in place prior to the close of escrow, must be signed. So at the close of escrow, the exchange account that we set up for the client, the money goes there. And that's when the party starts happening. You have 45 days. That's right, 45 calendar days to identify what you're going to buy in the 1031 exchange and a total of 180 days to close on it. In this market, that is not a lot of time, to be honest with you. So here's what I do. I do not list the property until I have an exit strategy in mind. I want a plan A, I want a plan B, I want a plan C. So if plan A doesn't work, I'm straight up going for plan B or plan C. If I can get a contingent offer in place, contingent upon the sale of my property, awesome. We all know that that's unlikely in this current market. But if I can't secure a property, or maybe this, right? I got a lot of clients out there that are buying properties that are still being built. Maybe I get into contract for my replacement property. Don't sell my relinquished property till I know it's going to be completed within my timeframes, but I've secured my replacement property. I know I could sell my property all day long right now. So I just wait it out. But the idea is you want a strategy in place so that when you list and go into contract, you're ready to execute, and the close of escrow occurs, money goes into the 1031 exchange account, and that 45-day clock starts. Now, within that 45-day period, you have to identify what you're going to buy in writing. So the way it works is you have one of three rules to choose. The first rule, three property rule. It says, all right, I can identify up to three properties of any value. This is the rule for people that are looking to buy usually one or two big properties. And it's a very common rule and the most often used. You identify, don't have to be three, but that's the max, those properties. And those are the only properties that you can close on after the 45-day period. You can't change the list after day 45. But what about the person? I got this dude that sold in San Jose for about $800,000, complete dump, condemned, couldn't even use it, wasn't even rented, sat vacant for about 12 years, free and clear. Still can't believe you could sell something like that for $800,000, but it was just the land underneath the structure that was selling. But he does a 1031 exchange on it. And the guy goes, he's like, I hooked up with this dude out in Buffalo and he's selling me condos at 30 grand a pop. HOAs are almost nothing. I'm renting it out for about $850 per unit. How many of these can I buy? Because I heard I can only buy three using the three property rule. I go, yeah, that's true. You can only buy three using the three property rule, but you ain't using that rule. We're going to go to the second rule, the 200% rule. 200% rule is as follows. You're selling for $800,000. 200% of 800,000 is $1.6 million. You are allowed to identify up to $1.6 million worth of real estate. Now, how many $30,000 condos could you identify if your cap is $1.6 million? The answer is a lot. All you got to do is buy $800,000 worth of these condos to pay zero in capital gains tax. And look at this, you are getting zero in income. And now I think he bought like 30 of them because that got him to like 900,000. And the last time I looked, 30 times 800 is like $24,000 he was making an income per month. Now there's some costs, so it's going to be a little bit less than that, but he went from zero to about 20 grand per month. That's the magic of a 1031 exchange. So if I'm looking to buy a lot of smaller properties, 200% rule. If I'm looking to buy the big bad property, 3 property rule. If I'm a gambler, just contact me and we'll go over the 95% exception. I've been doing this 23 years and done over 50,000 of these in my career. You don't use it unless I let you know that it's going to work for you. So 45 days to identify. You have to identify like-kind property. You're going to hear like-kind property out there a lot. And most people get confused because I have people, just the other day, this guy goes, I heard you could do bare land on a 1031 exchange. I'm selling bare land, but I don't want to buy bare land and I got to buy like-kind property. So I'm just not going to sell. And I'm like, who told you that? I go, that's not like-kind property. The definition of like-kind property, is it real property? Is it in the United States? And is it used for a business or investment purpose? And he goes, I didn't really use the land for an investment purpose. I go, yeah, you did. That's a damn good investment. You bought it 30 years ago for about 30,000 and you're in contract for $900,000 on this land today. That is a great piece of investment property. And you could 1031 exchange that into an asset that actually produces income. So if it's real property used for a business or investment purpose, it qualifies. So bare land qualifies, farmland qualifies, vineyards qualify, condo that's a rental, townhouse that's a rental, single family home that's a rental, duplex, triplex, 4-unit, 10-unit, 30-unit, office building, industrial property, retail property, hotels. You could even buy oil and mineral rights in a 1031 exchange. They qualify as real property. Cemetery plots, moorings qualify for a 1031 exchange. All kinds of crazy stuff that you may not even realize qualifies for a 1031 exchange is deemed real property and does qualify. So to me, it's like, what do you want to do with the money? What are you looking for? And I'll let you know if it does or it doesn't. But yeah, resi, commercial, resi investment property, commercial, all commercial real estate qualifies for a 1031 exchange because all commercial real estate is investment property. So 45 days to identify, follow the rules, make sure it's like-kind property, and do it in 180 days. And as long as you can make that happen within those timeframes, using all the money that comes from the sale, buying of equal or greater to what you sold minus closing costs, you'll be in a position to pay zero in capital gains tax. I had somebody call me yesterday and they go, hey, James, I'm selling this property for $1 million. I took out the closing costs. It's about 50 to 60 grand. My target price is like 940 to 950. I go, yeah, that's correct. And they go, you know what? I had no debt on this property. It's free and clear. And I found a perfect property for 900,000. I just, I'm cool with that. I don't want to do anything else. Can I do this? I go, absolutely. You'll just pay tax on that 40 to $50,000 and the trade still works. Your gain is like all gain for the most part. You bought it for under 100,000 and you're buying something for 900,000. Your target price is 940, 950, but it's not that bad to pay taxes on 40 to 50,000. It really sucks to pay taxes on 800 to 900,000. So buying of less value still can work, or you could buy a secondary property if you want. But sometimes people are okay with paying a little bit of tax, and some people have losses. I've had people say, you know what, I'm going to buy $100,000 less because I have losses carried forward that'll offset the gain. There's always strategies out there, whether or not it will or won't work for them. That's my job, to give them consultation to see what their options are and let them know pros and cons and do whatever they want to do. I talk more people out of doing 1031 exchanges. If they don't need it, I don't want it. But if they do need it, I want to show them the strategies and ways they can put things together to be in a position to pay absolutely zero in capital gains tax. I did want to mention two more things, and then I'll take questions. I can go on this forever, but I don't know how long. Hector, you didn't tell me how long you wanted me to talk. But
Yeah.
but there were two more things that I wanted to mention that are really important in today's market. I think the biggest problem about 1031s in the market today is there's no inventory, right? Things are going off the shelf quick style. You can't find a property, get into a property, make it happen in the time frame because another 30 people are trying to get the same property, and there's no guarantee you're going to get that property in a lot of situations. So what a lot of people are doing right now is the reverse exchange, where you buy first and sell second. And most people come up to me and go, hey, I didn't know I could buy the property first and sell my property second. If that's the case, let's do this all day long, because I know I will have no problem selling my property. I'm going to have a problem finding the property that I want, especially if it's somebody that's looking to buy a property that they're eventually going to move into. So a reverse exchange is where you buy first and sell second. Here's the problem. You can't own both properties at the same time as the client. So in order to make it work, client will go into contract to buy property, open up escrow. We'll put together our paperwork just like any regular transaction for a 1031 exchange. The difference is in a reverse exchange, a lot more paperwork, and we set up an LLC that will go on title to the property at the close, so the client is not on title to both properties at the same time. From that close date, they have 45 days to identify what they're selling. That's pretty easy. They know what they're selling and 180 days to close it. And when people hear that, they're like, let's do that. And I'm like, okay, well, hold on. First off, let me tell you why a lot of people don't do the reverse exchange. Number one, you haven't sold this property. So where are you going to get the money to buy this property first? Some people have the cash to do it. Some people have a down payment. Some people can get a bridge loan. Some people just can't make this happen. When you tell them they have to buy first and sell second, they can't make it happen. Now, the people where they have the cash to buy the property straight up from the beginning, it's easy. Bring the cash in, close escrow. We'll set up the LLC. LLC goes on title, 180 days to sell your property, get your money back from the property that's being sold when it closes. You're done. But what about the people that need financing? What about when it's residential property? What conventional lender will lend to an LLC? You ain't going to find one that'll do that. So now you're going to have to go private money. Hopefully the seller will carry back or get some sort of financing that'll work. It's not easy. So when you get private money in a reverse exchange, they typically charge 2 to 4 points on that loan. That could really start to add up. A regular 1031 exchange fee is about $1,000 to $1,200. A reverse exchange is usually around $6,000 to $7,000. And not only that, the LLC goes on title at the close. Well, the client could take over the LLC, but then there's $800 annual fees when you own an LLC, or they could put it back in their name, but you're going to get hit with dual transfer tax. Once when the LLC goes on title, second when they go on title. So the fees are significantly higher in a reverse exchange. But to me, if my gains are like 100, 200, 300,000, and I get the property I want, I'm cool with paying the fees. It's a case by case scenario depending upon what they want to do, but it's a very popular strategy that's being used in today's market because of the lack of inventory. Then the last thing I wanted to mention, and I get this quite often, is people say, all right, look, I bought the perfect property, but it's about $200,000 less than my target price, but it needs a lot of work. Can I use the exchange proceeds to improve the property? And I go, you can. There's two ways to do it, but I'll be honest with you, neither one of them are attractive. Here's the first way. call up the seller and say, look, let's change the contract. We'll increase the price to about $100,000 more. And I want you to complete the improvements by the close of escrow. No seller is going to really do that in this market. Maybe small improvements, but nothing major. The second and the more popular way is the improvement exchange. The improvement exchange is similar to a reverse exchange. So what happens is that you go in contract to buy that replacement property. We'll put our paperwork together. We'll set up an LLC. LLC goes on title at the close. While the LLC is on title, the improvements can be done, but they have to be completed within 180 days. That is not easy to do, to get things done, especially if permits are needed within 180 days. And how much money can I actually put towards the improvement? Because I have people saying, yeah, I want to do a whole house that's going to be built within the 180 days, and it's in Tahoe. Really? It's like November. You're going to make this happen in the winter months and get things completed within 6 months? I doubt it. It's going to be difficult. It's going to be difficult, a tough task to accomplish. But if you can make it happen, the improvement exchange is an option. And with that, what questions do you guys have, or what else do you want me to go over?
You covered it pretty good for me, but I am going to unmute my partners, Armando, some of the realtors. So I know they'll have more questions. Armando's an investor himself, so I think he might have some questions. And I'm going to unmute Jesus, another realtor in our team. So Jesus, I think this is probably your first time hearing one of these, and you've been trying to get into it. Do you have any questions for James? Well, we got him.
No, man, he covered a lot. I mean, I got all my notes here. This is he went through as much as I could think of, in the 1031 for sure. Something that I just had no clue was a thing. 200% rules, stuff like that. Yeah.
Armando, you're always flipping properties. Any questions for James while we got him on the line?
Dude, I'm good. I've actually listened to him a couple times already, so yeah.
I know you guys knew him before, kind of introducing him to everybody else. You covered it, James. You nailed it, man. I appreciate it. We got a couple people that need your services, so this information helps. We'll get back with them and hopefully get in contact with you and send them over to you.
And Hector, my advice on the 1031 exchange, y'all don't have to be experts on this. You have to be able to identify a situation and put me in the mix. Consultation's free, right? I mean, I'm more than happy to get on a call on a Zoom, find out if there is an opportunity for the client and for you and for myself to get involved and help them out with the 1031 exchange. And I only want to do this for somebody that needs it. So it's really easy just to find out whether or not it's something that they should entertain. I think most people now that own investment property have massive appreciation because ever since COVID, that's what's been happening. So I think you just need to bring it up. Have you considered a 1031 exchange? When they say, what's that? Oh, it's when you sell investment property and instead of paying the taxes, you buy other investment property and you don't have to pay any of the taxes. Because a lot of people come to me and they go, oh, no, I'm just going to pay the 15%. I'm like, 15%? What about Gavin? And you're shortchanging Sam. And what about Obama? And they're like, what are you talking about? Like, well, there's depreciation recapture, there's federal tax, state tax, and the healthcare surplus tax hits you as well. And you're probably going to pay about 30 to 35% on every dollar of gain. So before you make a decision, find out exactly what the consequence is, because if you think it's 15 changing to 30 to 32 to 35, that's a big difference in terms of what you'd be paying in taxes. So I think it's very important that we understand all we have to do is identify an opportunity, then implement our team. And if the client refuses to do something, it's on them. The last thing I want is for the real estate professional not to do their fiduciary responsibility and point out different things in the transaction where there might be cause for alarm because the client does not know. One of the things I did not mention, whoever sells the property has to buy the property. I know that sounds really simple, but like for me, for example, I bought my first piece of real estate about 22 years ago, and I bought it when I was single, and I got married, and that eventually turned into an investment property, but I did not put my wife on title to that property. And when I sold it, I was looking to do a 1031 exchange, and I was looking to buy with my wife. So if I sell as James and buy as James and Angie, let's just say I sell for 800,000 and I buy another property for 800,000, I'm only buying 400,000. I would need to buy 800,000. Now there's ways to fix things like that because we've been married forever and we could easily quit claim her on title because we filed jointly in a community property state. that's just one example, right? There's like the partnership, the LLC that's on title that should be doing the trade instead of the individual. There's the irrevocable trust where you inherited the property, but it didn't sell it then, and you had appreciation afterwards, and there's 3 children that own it. There's all kinds of scenarios. Just remember, the taxpayer that sells has to be the taxpayer that buys. So when you start hearing that there's multiple people involved, find out who owns it. Some are obvious and we don't have to ask those questions, but sometimes when it comes to investment property, there's more than one owner on the property and there's different situations in the property. You don't want that to come up when you're in contract. You want to deal with it before you're in contract so you're prepared for things to go smoothly. I see that happen more for commercial real estate, right? You got a bunch of different owners in one LLC and they want to go in their different directions. It's a big problem in 1031 land. You don't see that as often for residential property, but just, you could always email me or ask me questions. I do have a cheat sheet that you could ask certain questions when you're interviewing a potential client that will eliminate some of the problems that could happen in a 1031 exchange on both residential and commercial property. Actually, I have a PDF on almost everything I ever talk about on 1031. So if there was a particular subject matter, or you wanted to go more into marketing to people that own investment properties, I've got like over 20 postcards and flyers of the different reasons why people should considering unloading their properties where they could call you, all the things that I mentioned earlier. So any of that information or any of those materials that you want, feel free, reach out. I'm more than happy to share that stuff. And if you need me, I'm just a phone call or Zoom, or I started meeting people in person. Again, I've been fully vaccinated and it's good to get in front of people. I have done that multiple times already.
Perfect.
And it seems like we have a bunch of Latinos on the line today. So if you need material in Español,
Oh, man.
tenemos impuestos, intercambios, all that crap I can talk about. I don't like to do it in Spanish because I'm second generation.
Same here.
And you all sound like you speak Spanish better than me, so I'm not going to embarrass myself on the call. I'm half Nicaraguense and half Salvadoreño, in case anybody else here is from my countries. But love all my Latino family on the call today as well.
Yeah, appreciate it, James. A lot of good information. It helps a lot. Well, I'll hit you up for some of that cheat sheet stuff.
Okay.
I saw some already on your website, so I know some we could already go get ourselves. But anything else, man, we'll reach out and we'll start working together, brother. I appreciate it.
Where are you guys located? I never asked.
Oh, sorry. We're in the Central Valley, Cobo Banker in Modesto.
Okay.
Yeah, we have an
Okay.
office in Modesto and Turlock. I met you at a PMZ in Oakdale 7 years ago or something when I first got licensed.
Yeah. I've spoken in all those offices. And who was running the Coldwell Banker back in the day in Modesto?
Oh, it was somebody else.
Oh wait, it was Vincent Chase's office,
Chase,
right? I
yeah.
mean, yeah, it was, and that's Remax now or something, that location. So where are you guys located? Are you still on Stanford?
So we went from Standerford to downtown Modesto.
Okay.
So we're downtown Modesto, across from the library, the Modesto office.
Okay.
Our Turlock office is behind the little downtown Turlocks, all the little restaurants and stuff.
Yeah, no, Turlock's cool.
Uh,
Next time when we start doing things in person, we should do some sort of lunch and learn or something like to see
That'd
you
be
guys
great.
all in person and maybe invite your investors to the seminar and we could, do it however you want. I think that'd be a great idea when things really open up. And you guys
Yeah.
are the Central Valley. You guys are all open anyway, right?
Yeah,
They handcuff us in the Bay Area.
yeah, man, we're free to roam over here, so it's good.
Yeah, so just let me know. Pleasure to be on the call today. Nice meeting all of you. Although I think everybody was a coward except for Hector and Jesus, but everybody else.
The
nice
rest of them,
meeting you
they're
all.
they're actually our virtual assistants, so they're the ones making the calls, getting us the leads. And often they get these questions. I'm like, you know what? Let's have a meeting with them. You can hear it from him himself, and then we'll go from there. So you explain a lot better than I do for sure.
It's not your job to explain this stuff.
Not my
It's your
job.
job to sell and buy real estate. All you guys got to do is
Exactly.
remember that you do not want lawsuits. I've seen that happen to realtors that think that the other realtor is giving information. That other realtor is going to be in a heap of trouble. When you have an expert, a team member that can help you out, that's been doing this as long as I have, you should be in good hands. And if not, our firm has over 25 attorneys that I could bring into the mix if needed in a certain situation. It doesn't really go to that level that often, but in certain scenarios, when it gets really sticky, I ain't going to give the answer either. That's
Yeah.
why we have that's why we have legal counsel.
Exactly. Well, cool, man. I appreciate it. We'll
Okay.
reach out to you. And
Thank you.
very
Thank you,
much.
James. I appreciate it.
Thank you, Jesus. Pleasure to meet you. Thank you guys all.
Adios.
Adios.